Dustin, very good to see you. Today, we are talking through a tax smart alternative to cash. It's been a long time since we've seen inflation adjusted interest rates above zero. Since the Fed interest rate hikes, though, investors can once again earn attractive rates on cash. So, what are some of the questions a risk averse investor should ask when considering CDs, treasuries, or other cash savings?
Sure. Well, the first thing that they usually consider is, hey, what's the return? What's the interest rate? That's important, right? But then you should ask, well, what's my return after things like taxes and inflation?
Right.
So remember, if you're buying those things, CDs, treasuries, bonds, et cetera, that pay interest, you pay income taxes on that interest that's passed through each year. Well, if you're able to earn 5% on cash or cash alternatives, and let's say you're in a 24% tax bracket, your return after paying taxes is only 3.8%. In the current environment we're in, after inflation, your return's less than zero. Okay.
Yeah.
So that leads you probably to another question you want to ask is, well, what are my alternatives?
Why are you taking my questions, Dustin? That is my question. Absolutely. So,
Okay.
what are the alternatives that you're suggesting? Because I know that you and I have talked before about buffered ETFs. Where do they play in?
Yeah. So for a risk adverse person who's looking to protect their cash, specifically protected in a tax efficient and tax smart way, what I'm looking at right now is buffered ETFs that offer 100% principal protection or 100% downside buffer. So real quickly, if we just explain how buffered ETFs work, buffered ETF tracks the performance of an index like the S&P 500, but it's not something where you're invested in the S&P 500 or any index. It tracks the performance of that index. And you've got an outcome period, let's say a 1 year period or a 2 year period. And at the end of that outcome period, you're going to have a set of defined terms. Okay. You will participate in any positive returns in the index up to a cap. Okay, so let's say at the end of an outcome period, if we're tracking the S&P 500 and we have a 15% cap, let's say at the end of an outcome period, the S&P 500 is up 20%. Well, you get to participate in all those gains up to the cap. So the S&P up 20, you'd be up 15. Okay.
Mm-hmm.
Now, conversely, let's say at the end of an outcome period, the S&P 500 is negative. Let's say that you've got a 15% buffer. Well, you would only participate in the losses that go below that buffer. So if you had a 15% downside buffer and the S&P 500 were down 20%, at the end of that outcome period, you'd be down 5 instead of
Wow.
20. Okay, so
Mm-hmm.
that buffer protects or eliminates a lot of the losses at the end of the outcome period. Currently the terms I'm seeing on buffered ETFs, the principal protected buffered ETFs, we've got 100% downside buffer. So that means if at the end of the outcome period, the index, for example, the S&P 500 is down to any extent, you don't participate in any of those losses. Okay, so your principal is protected. If at the end of that outcome period, again, the index is positive, you participate in the gains up to the cap. And the caps I'm seeing currently on these principal protected buffered ETFs are somewhere above 15%.
Mm.
So it offers more return potential than cash, CD, savings, money markets, treasuries, and most bonds. So be
Interesting
a
when you
very
confirm that.
attractive way to protect your principal.
So you've said before that there's one thing these buffered ETFs offer that's really getting your attention. What is that?
Yeah, what's really getting my attention is the tax treatment. So
Mm-hmm.
is this a way to protect your principal and potentially earn more than other cash alternatives? Anytime you own the things we talked about, CDs, treasuries, most bonds, money market accounts, all those things, all those ways of protecting your principal, all those investments pass through interest each year, and you've got to pay income taxes on that interest each year. And income tax rates are among the least favorable tax rates. Okay. A buffered ETF doesn't pass through interest. If you've got gains at the end of the outcome period, those gains are simply rolled into your investment and rolled into a new outcome period.
Mm.
Okay. And when that investment is sold at a point of your choosing in the future, if it's held more than 1 year, you'd be subject to long-term capital gains rates. So we talked about it as an example. If you're in a 24% income tax rate, you'd be looking at about 15% long-term capital gains. but you wouldn't have to pay those taxes each and every year like you do on a CD. You would only pay that 15%, for example, when you sell the ETF. So, in my opinion, makes it a really attractive, tax smart way to protect your cash.
Yeah, really interesting. I'm glad we got to talk this through because Dustin and I literally have a money market saved on my phone right now with 5.65, but now it's not as attractive now that we've talked this through. If somebody has questions and wants to crunch the numbers with you, what's the best way to reach you?
They can shoot me a text at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
All right, Dustin, thank you.
Thanks, Aaron.